The stock that made you wealthy can also become the thing that makes your financial life fragile. That sounds backwards. If a stock has risen for years, paid dividends, split several times, and turned into one of your biggest assets, selling part of it can feel almost irrational. You may know the company better than any other investment you own. You may have worked there. You may have watched the business survive recessions, competitors, scandals, and market crashes. And every time someone told you to diversify, the stock may have gone up again. So concentration starts to feel less like risk and more like proof that you were right. That is exactly why this risk is so easy to miss. Concentration risk rarely looks dangerous while the stock is winning. It looks like success. The danger appears when one company becomes responsible for too many parts of your financial future at the same time. Today we are going to look at why that happens, why smart investors often refuse to fix it, and how to think about diversification without pretending you can predict which stock will fall next. Start with a simple idea. Owning a great company is not the same thing as owning a safe portfolio. A company can remain profitable, innovative, and admired while its stock still falls hard. A stock price reflects expectations, valuation, competition, interest rates, regulation, management decisions, and what investors believe comes next. The business does not have to disappear for shareholders to suffer. Sometimes it only has to disappoint. And when one stock represents a large part of your wealth, disappointment can become a household financial event. Imagine you have a $1 million investment portfolio. $500,000 of it is in one stock. If that stock falls 30% while everything else stays roughly flat, your total portfolio loses about 15% from that one position alone. The problem is not that a 30% decline is guaranteed. The problem is that one company has been given the power to decide too much of the outcome. That is concentration risk. It is not a prediction that your favorite stock will fail. It is an admission that you do not know the future well enough to let one company control it. This is where diversification is often misunderstood. Diversification is not a statement that every stock you own is equally good. It is not a promise that a diversified portfolio will never lose money. And it is not a strategy for maximizing bragging rights in a bull market. Diversification is a way of limiting how much damage one mistake, one company, one sector, or one surprise can do to your plan. That sounds boring when markets are rising. Boring becomes valuable when something breaks. The emotional problem is that concentrated positions are often created by success, not by recklessness. Maybe you bought a stock years ago and it multiplied. Maybe company shares accumulated through compensation. Maybe you inherited the position. Maybe you kept buying because the business kept proving you right. The position grows faster than the rest of the portfolio. Soon 10% becomes 20%. 20 becomes 35. Then one day you realize the stock is no longer just an investment. It is the investment. And now selling feels psychologically harder because the position carries a story. It may represent your career. It may represent the smartest decision you ever made. It may represent your loyalty to a company. It may represent the inheritance your parents left you. It may even feel like part of your identity. That is why concentration risk is not only a portfolio problem, it is a behavioral problem. The more successful the stock has been, the more evidence your brain collects that holding it was correct. Then past success quietly becomes confidence about the future. But the future does not know your purchase price. It does not know how long you worked at the company, and it does not care how many times the stock rewarded your patience in the past. Here is a question that exposes the problem. If you had the same amount of money in cash today, would you choose to put that much of it into this one stock right now? If the answer is no, then part of the reason you still own so much may be history rather than strategy. That does not automatically mean you should sell it all. It means the position deserves a decision, not inertia. There is another reason concentrated wealth feels safer than it is. Familiarity feels like knowledge. If you work for a company, use its products, know its executives, or follow every earnings call, you may feel you understand the stock better than strangers do. Sometimes you really do understand the business better. But knowledge of a business does not remove market risk. It also does not remove the possibility that the market already knows what you know, and it definitely does not guarantee that your personal financial exposure is appropriate. This becomes especially dangerous with employer stock. Your salary may come from the company, your bonus may depend on the company, your career opportunities may depend on the company, Your health insurance may come through the company, and then a large part of your investment portfolio may depend on the same company too. That is not just one basket. It is several important baskets sitting on the same shelf. If the company struggles, the stock can fall at the same time that layoffs, reduced bonuses, or career uncertainty appear. The financial shocks can arrive together. That is the opposite of what diversification is supposed to do. Diversification tries to prevent unrelated parts of your life from failing for the same reason at the same time. Now consider retirement. Concentration risk can become more dangerous as you get closer to the point when your portfolio must support your spending. When you are 35 and still earning, a major decline can be painful, but you may have time, income, and future contributions to recover. When you are 65 and planning withdrawals, the same decline can collide with a completely different reality. You may need to sell assets to fund living expenses. You may not want to return to work, and the time available for a recovery may matter much more. This does not mean retirees should never own individual stocks. It means the cost of one position going badly can change when the portfolio stops being a scoreboard and starts becoming a paycheck. That distinction is crucial. A concentrated stock position can make you wealthy on paper, but retirement security is not measured by how impressive one line on a brokerage statement looks. It is measured by whether the entire financial plan can survive bad outcomes. The hardest part is that reducing concentration can feel like voluntarily giving up upside. Suppose a stock has doubled and you sell part of it. Then it doubles again. You may feel foolish. You may calculate exactly how much more money you would have had if you had done nothing. That regret can be brutal. But diversification was never designed to guarantee the highest possible return from the best-performing stock. It was designed to reduce the consequences of being wrong about which stock would be the best-performing stock. You are buying resilience, not hindsight perfection. This is the trade-off many investors never say out loud. Concentration can create extraordinary wealth. Diversification can make extraordinary wealth easier to keep. Those are different jobs. Building wealth and protecting wealth do not always require the same level of risk. A strategy that was reasonable when one position was small can become unreasonable after that position grows tenfold. The stock may not have changed. Your exposure did. That is why portfolio risk should be measured in dollars and consequences, not only in percentages. A 40% position means something very different in a $100,000 portfolio than it does in a $5 million portfolio if the rest of the household plan is already secure. The right question is not whether a particular percentage is universally too high. There is no magic number that fits every investor. The better question is what happens to your life if this one position is cut in half. Would retirement still work? Would you still be able to fund healthcare? Would you still help your children the way you planned? Would you still sleep at night? Would you be forced to sell the rest of the portfolio at a bad time? If one stock falling 50% would force major life changes, then the position may be carrying more responsibility than one stock should carry. And notice what this test does not require. It does not require you to predict whether the stock will actually fall 50%. Risk management begins before prediction. You do not buy homeowners insurance because you expect your house to burn down next Tuesday. You buy it because the consequence would be severe if the unlikely thing happened. Concentration risk deserves the same kind of thinking. Now let us talk about the most seductive argument for doing nothing. I do not want to sell because I will owe taxes. Taxes matter. Transaction rules matter. The cost basis matters. The account type matters. And selling blindly can create an unnecessary tax bill. But avoiding a tax bill and avoiding investment risk are not the same goal. A tax consequence is visible and immediate. Concentration risk is uncertain and delayed. That makes the tax bill emotionally louder. But a decision should compare the cost of diversifying with the cost of remaining concentrated, not pretend one side is free. Sometimes the right answer may be gradual diversification rather than one giant sale. Sometimes new savings can be directed elsewhere so the concentrated position becomes a smaller share of the total over time. Sometimes charitable, estate, compensation, or tax considerations make the decision more complex and worth professional advice. The point is not to prescribe one selling strategy. The point is to stop treating inaction as if it were not a strategy. Doing nothing is still a decision to keep the concentration risk. Here is another trap. People often say, I will sell when the stock gets back to a certain price. Or, I will sell after the next earnings report. Or, I will sell after the next dividend. Then the target moves. A rising stock makes selling feel unnecessary. A falling stock makes selling feel painful. So the investor becomes trapped in a position that is somehow never at the right price to reduce. That is how concentration can survive for years without ever being consciously chosen. A better approach starts by separating two questions. First, do I still believe this is a good company or a good investment? Second, even if it is, do I need this much of my financial life tied to it? Those questions can have different answers. You can love the company and still reduce the position. You can believe the stock will rise and still decide that your family does not need to make such a large bet on that belief. Diversification is not betrayal. It is position sizing. And position sizing is the difference between having an opinion and staking your future on it. Now imagine two investors. Maria is 58 and has worked for the same technology company for 22 years. Between stock grants, an employee purchase plan, and years of appreciation, company shares now represent nearly half of her investable assets. She knows the company well. She trusts the leadership. And the stock has been one of the best financial decisions of her life. But Maria's salary, bonus, career, and portfolio are all now connected to the same business. Her biggest risk is not that the company is secretly terrible. Her biggest risk is that she needs too many good things to keep happening at one company at the same time. Diversifying part of the position would not mean she suddenly hates the business. It would mean her retirement no longer requires the business to remain exceptional. Now imagine James is 70. He owns one stock that grew dramatically over 3 decades and now represents a large portion of his taxable portfolio. His pension and Social Security already cover his essential expenses. He has substantial diversified assets outside the position and no major debt. For James, the consequences of concentration may be different from Maria's. When abdotcherer, that does not make the risk disappear. It means the risk must be judged in the context of the whole household, not by a slogan or a universal percentage. That is the deeper lesson. Concentration risk is not about punishing conviction. It is about preventing one conviction from becoming a single point of failure. A strong financial plan does not need every investment to work. It needs the plan to keep working when some investments do not. That is what diversification is really buying you. Not mediocrity, not fear, not an apology for missing the next 10-bagger. It buys the ability to be wrong and still be okay. And as your wealth grows, that ability can become more valuable than squeezing every possible dollar out of the position that got you there. So before you look at the stock price again, look at your exposure. Ask what percentage of your investable wealth is tied to one company. Ask whether your income or career is tied to that company too. Ask what would happen to your financial plan if the stock fell sharply and stayed down for years. Ask whether you are holding because of a deliberate strategy or because selling feels emotionally difficult. Ask whether taxes are a planning issue you can manage or an excuse that prevents you from managing risk at all. And ask the hardest question one more time. If this money were cash today, would you choose to put this much of it into this one stock? If you would not, your portfolio may be telling you something. The hidden danger of concentration is not that one stock can go to zero. That is the dramatic version. The more common danger is that one stock becomes important enough to change your life if it merely goes wrong at the wrong time. A great company can still be too much of a good thing. A winning investment can still become an oversized risk. And the goal of diversification is not to make you less confident. It is to make your financial future less dependent on being right about one company forever. If this helped you see concentration risk differently, subscribe for more practical personal finance and retirement guidance. And before you make your next investment decision, look at the biggest position you already own. It may be telling you more about your real risk than the rest of your portfolio combined.